All right, we're live. Thanks again for agreeing to talk and sort of update from when we last talked a couple of months ago, again in advance of this October 20th Energy Awards panel and feature that you're in and all that. So just
PR confirms it has received the SEC letter on.
Sorry, I just turned that off. It'll go away in a second. Okay, go ahead. Sorry.
Okay, so how would you characterize U.S. oil and gas production right now? And you can take either one in any order.
Well,
Voting shares remain halted.
sorry, let me just, oh, here I see what you're doing. I would say that U.S. production is steadily increasing of both oil and natural gas, but the natural gas part of it is a little more volatile because the prices come down pretty substantially. So there probably was some peak production occurring when we were at $9–10, and now we're closer to $6. So some of that peak type production's gone, but steadily increasing. No, slow increases in rigs, but nothing dramatic. Not like we used to have when prices spiked.
Yeah. So is there anything different with regards to pricing? I'm trying to think where we were 2 months ago. Weren't we closer to 100 a couple months ago?
Yeah. So we don't think that this downturn in prices really reflects fundamentals. It's very normal for energy prices to drop during what's called the shoulder months, because there's no significant heating demand and no cooling demand and no significant driving demand, because kids go back to school, so there's no vacations, no Christmas, there's no Thanksgiving, and the weather is cool. Like right now it's like 60 degrees in Manhattan. So you're neither getting a lot of cooling demand nor heating demand. And also the stock market's typically weak, and most people don't recognize it, but the oil is 80% correlated with the stock market. So the combination of those two factors drive it down. We think that when we get into the winter, the prices will go back in that $90 to $110 range.
Mm-hmm. So that's interesting that I didn't know it was 80% correlated with the stock market. That's an interesting stat. So how are you modeling U.S. demand right now, given that we have this sort of Fed issue, and we know that Europe is, there's a lot of talk that they're heading more towards a recession.
We actually think that demand is way more sticky than people realize. So that's mostly true in China. And a lot of this just comes from the media, because oil prices are down. They're like, well, why are oil prices down? And then they have to come up with a reason. They're like, oh, because China is locking down. When you really go look at the numbers, it's extremely sticky. It just grows very slowly over time.
Yeah.
And maybe there's a little blip because of a lockdown or slowdown in their economy. And we think the U.S. demand is going to continue to be strong, because we're really have a juggernaut economy. It's benefiting from pandemic tailwinds, emerging from the pandemic tailwinds, from strong manufacturing because Europe is imploding. And then Europe, in terms of incremental variations in supply and demand, is not that critical. They don't burn nearly as much gasoline per capita as we do, because their prices are 4 times as high as ours. So they're not the key driver really of global demand. So we don't see demand falling off the cliff. Although from time to time, if prices are weak, that may be used as an explanation. But we think that the key drivers of demand are more like the United States, China, and India, and those are relatively resilient economies right now compared to Europe, at least.
Yeah. And China, India, still where more growth, more rapid growth exists relative to our more steady growth rate.
There's so much secular growth that a little cyclical decline is not that significant.
Yeah. Just FYI, your screen is running in the back, like the show is running in the
I
background.
can turn that off now.
There. So how would you describe the natural gas world right now, in the US and then in Europe?
Well, in the US, natural gas is normally almost a waste product. And of course, it was more true when natural gas was at $2 an MCF versus 6 versus 10. It was really just a byproduct of drilling for oil. So the price of oil really drove drilling. Now it's starting to become material at $6 and up to 10, where companies will actually, make drilling decisions based on the natural gas economics. And it's great for integrated companies that were really dealing, like EOG is a good example. They actually have tremendous natural gas, but everybody kind of ignored it for the last 5 years because the prices were so low.
Right.
So I would say it's still driven mostly by the oil content, because almost every well, but for some in Appalachia, are dominated by oil, and then you just get natural gas as a byproduct. So steady increases. I don't think the good news about not ramping production up is whether we're at 80, 90, 100, 110, we're going to probably just continue to get this steady increase in production, a few more rigs coming on, but not the volatility that we used to have where companies would pull rigs just because we went down $10.
Yeah. So you see, so what about this, tightness story that there's still concern about in terms of, oil production and demand, like this mismatch that maybe there's not as much supply moving as fast if there is in fact this, steady movement. And we know there's been less investment because of, ESG.
I think that the component that most people miss is that all energy sources are fungible. So if natural gas is in shortage in Europe, which it still is, it actually has come down significantly during the shoulder months, but we don't know what's going to happen during the winter. But what we do know is that refined products, particularly heating oil, are at almost near all-time high crack spreads or profit margins. And so what most people don't appreciate is that shortage of natural gas is sucking all energy into Europe to try to offset it. Coal, so there's more coal being burned.
Right.
Definitely distillate being used. And this doesn't have to be to generate electricity, it can be in manufacturing facilities. So there's kind of a giant sucking sound coming from Europe with this natural gas shortage, and it's driving all commodities. And that's really kind of the core of our bull case on oil. If it were not for, and of course the explosion of the Nord Stream 2 pipeline further cements that bull case. But if it were not for that shortage, then we probably would have downgraded, particularly during this time frame, our forecast for oil, because we don't have that as a backdrop, because then you would just be stuck with the macro, which is, as you pointed out, pretty dicey, particularly in Europe. But with that energy shortage driving probably 1 to 2 million of additional demand for oil, if not more, because that distillate crack at about $60 is just pretty profound. Gasoline's at 20 and distillate's at 60. So that's underpins our bull case for getting back into that 90 to 110 range. And also, as the market calms down, the dollar is no longer skyrocketing. So that helps, because everybody kind of forgets that 80% of demand is in non-dollar demand denominated. So when the dollar rises, it clearly hits the dollar price strengthens, I should say.
So you think that, with this natural gas shortage in Europe, owing to Russia, and then it's pulling other, mixed sources, i.e. oil in its various forms, and it's going to manufacturing, more manufacturers are using it. Are you saying that pretty soon we're going to see the price of oil more reflected of this
Correct. There are two dynamics. The first is that you just come out of the shoulder months, so there's more real demand for the product versus people having to store it because there will be demand in 2 months. Number one, and then number two, there will continue to be this substitution effect of all energy sources.
Yeah,
So that's what people don't sort of forget.
right.
The energy is fungible. And that, Europe's key mistake, though, it's fungible, but in terms of providing peak power and backup power, natural gas is superior. So that is their key area, is having inadequate supplies of natural gas. Whereas in the US, every power pool de facto has tremendous backup reserves of natural gas because they contract for it. Or most of them do. Like PGM actually contracts for capacity. So who's ever prepared to provide that capacity has to have natural gas backing that up.
Yeah, and then we heard, that oil trader was talking about how 22 more coal-fired plants got going in Europe, and then there's coal coming from different parts of the world to meet that demand because of owing to the lack of natural gas supply. And so
right, that's kind of the core insight, is just that there's a notion that you just look at these markets separately, but they're all providing energy.
right.
And a lot of it arbitraged, particularly on the power side, because you can burn distillate instead of burning natural gas. Most power plants, you can switch between distillate and natural gas, and a lot of industrial processes are set up that way, so you can arbitrage between natural gas. Because even in normal markets, like in the Northeast, there are shortages of natural gas. So those power plants are required to have backup distillate, and a lot of the industrial boilers have it because they don't want to be shut down just because it's cold in the Northeast. There's not enough gas in Boston, so they can't do manufacturing. So that switching element is overlooked oftentimes.
So are you saying that in Europe they don't have those backup contracts to cover themselves?
Well, what they failed to do, because they were just doing an energy market and not a capacity market, that they didn't contract for backup power if the wind didn't blow offshore, or if there was a problem with the solar or demand out when those two weren't operating. So they didn't, and actually it happened in Texas as well.
Right.
This is a fully deregulated market, so you're in theory supposed to have backup generators that'll just go in and capture these price spikes, but in practice, it's hard to finance when you have a pure market like that with no capacity. So they failed to have backup capacity on the electricity side. And then obviously, this is 2020 hindsight, although many people criticize Europe for relying on the Russians for natural gas. And that was a big strategic issue what the United States had with Europe. So they really failed on two fronts. They failed on sort of their normal energy transition, and then they also failed in terms of the strategic backup. There was a problem with Russia. So that's why it's such a horrendous crisis. And why Europe is headed into a recession is it's a failure on top of a failure.
Yeah, I was just reading this article today about Germany and how, like there's a lot of manufacturers that are actually considering not investing anymore there and looking elsewhere because of the situation with energy. And I was really, we saw that happening, Volkswagen early in the Ukraine invasion, mentioned that, there was an article about they were gonna do a plant, I think in Mexico, somewhere in North America. And that was like that, I noticed that, and now you're seeing more exodus,
obviously the United States is where you'd want to be. Well, North America is where you'd want to be.
Right.
We're the only country that has tremendous reserves, but restrictions on exports right now because of permitting. So the prices you know, your cost advantage is anywhere from 60 to 80%, depending on what's going on in Europe at the moment.
So is there enough like production elsewhere to, of natural gas to adequately supply Europe?
There is, it just that there's a lag time in terms of the export capacity. So in other words, there's enough production of it, but it can't all be exported. That's the key issue in the United States. We only have about just over 10% of our production gets exported. And it's very difficult to permit new export facilities. And there are incremental barriers that have been put up by the Biden administration in terms of getting those approved.
Right.
Or analysis that needs to be done about carbon impact, which isn't explicitly limiting it, but is de facto limiting that expansion. And even away from that, it's just not as simple. Massively expensive facilities require not only supply contracts for the natural gas, but also, of course, offtake agreements with creditworthy entities. So putting those deals together just takes a long time.
Yeah.
There's existing exporters like Cheniere who can easily expand their facilities, but it's not going to happen overnight. So the problem will probably be fixed in 3 to 5 years, but not 1 to 2 years.
Yeah, not soon enough. So, okay. And so would they have to get gas from, the Middle East, like Qatar and other places? I mean, and are they able to meet that demand? I mean, what do you see?
And ultimately, there's not enough natural gas probably to satisfy all the demand. So that's where this substitution comes into play. So China might have, in theory, in better political times, tried to contract for way more natural gas, but now they're just building 40 gigawatts of coal every year. So gas that might have gone to displace coal in China is probably going to go to Europe.
Yeah.
So,
Plus, yeah.
So there won't be a shortage, but it's unfortunate because it's terrible for the environment to burn coal versus natural gas.
Oh yeah, absolutely. Well, and also I was reading an article today that the Chinese have been over contracting LNG and then not taking it all and shipping it elsewhere and making decent profits.
There's definitely tremendous arbitrage opportunities going.
Yeah, it's it's unfortunate. So what is your take in terms of, while we're still on oil and gas, in terms of investment? There was this narrative of, there's not as much investment in oil and gas because of all the ESG, the sustainability funds, blah, blah, blah. Is that now, with all these energy security issues, do you think are you seeing any change in mood or investor sentiment with that?
Well, there's definitely way more openness to buying energy companies, because there's definitely, the consensus was that hydrocarbons are going away within 10 years.
Right.
Which was never even remotely supported by any reasonable projections.
Right.
For instance, in the US, I call it pure renewables, which means wind and solar, because you really can't expand geothermal and nuclear in the United States, or hydro. Like in my home state of California, you're not building you'll be lucky if they don't knock the existing dams down. You're not building a brand new Hetch Hetchy, is the biggest dam in the Sierras that supplies San Francisco with water. You're not building a new hydroelectric facility. Geothermal is limited, and nuclear is limited now by, at least in the United States, because of permitting. So the part that can grow is only 5. So renewables are roughly 20, 15 of which cannot grow. So it's only 5. So if anybody had done any kind of reasonable projection, they'd say, well, 5% growing at 20% is 5, 6, 7, 8, 9, 11. And so after 7 years, you're at 11, not 100. But now because of the implosion of Europe, that's pretty much consensus. So people are open to investing in energy companies, but the companies have been burned badly enough over the last 5 years that they're not going to rely on that the current shift in sentiment.
Right.
They're just going to slowly grow production, return a lot of cash to shareholders. The shareholders like that. It
Yeah.
lowers risk. Their returns are higher. So there's not going to be, and also there's really no significant effort by the government to change that dynamic, notwithstanding some political talking points around that. So that's likely to be the status quo in most of the world for the next 5 or 10 years. So it's going to require high prices, which is okay because that's a way to price carbon. I mean, you can actually explicitly price carbon, or you can just have hydrocarbons be massively expensive. So we have closer to the latter.
Right.
That does, at the margin at least, limit carbon production. But it would be better, obviously, if there was a global tax on carbon.
Right.
Then you'd have income versus just cap and trade income, which you could disperse to emerging market countries or coal miners. And then also you wouldn't have to wring your hands and say, well, will we ever limit carbon? Because you could do it overnight. If you had $100 a ton tax, the next day you could make it 1,000, and the following day 10,000. And that the use of carbon would drop by, orders of magnitude.
Yeah.
But now we just are reliant on these one-off, bills like the IRA bill.
Right.
And subsidies, but subsidies don't guarantee production. If you tax substantial amounts of carbon at huge prices, you're going to get way less carbon. So that's unfortunate. But like I said, sort of by accident, we've created the situation where the best environmentalist is an economist, so prices are higher, so de facto carbon prices are higher, and so we will have less consumption than we would have otherwise had. The tragedy is we have more coal production because environmentalists have opposed all hydrocarbons as opposed to dirty hydrocarbons versus natural gas.
Right. Yeah, I was wondering, because I was thinking about, with these like carbon funds and, different regimes, there's a lot of different regimes. They're scattered. There's voluntary markets, there's involuntary markets, there's Europe's market, there's China's market. I just wonder if the incentives are so askew right now that it's just funds, and it's not really an effect. It's not really solving a problem, per se. It's just kind of moving money around,
Well, I'd say the biggest problem that we have right now is really China, because China has stopped any negotiations as to what their future path of carbon production is going to be. And if you think about it from a magnitude perspective, China emits about 11 billion tons a year, and Europe 4. So Europe's in the vanguard of reducing carbon, but it doesn't matter.
Right, because of China.
They're at 4 and they reduce it 10, that's 400,000 or 0.4 billion tons. But China might have increased it by 0.5, then that's over 5 years. They might have done that in a year. They open up 40 gigawatts of coal. So until we improve relations with China and get them to, agree to some cap and trade type limits, everything else that's done is essentially a waste of time. The argument is that, well, it puts us on a moral high ground to negotiate with China. That seems like a pretty expensive moral high ground.
Yeah, it's pretty flimsy when it comes down to.
And, it is. I think it's great that we pass the IRA bill because it limits local pollution, which nobody discusses. They treat carbon as if it's, and focus on 50 years from now when we're going to have Armageddon. But today we're breathing in coal dust in Manhattan because we haven't shut down these coal plants. So it's great to deal with local pollution, but it doesn't obviously solve the global problem.
Right. Right. Yeah. I was going to ask you your take on the, Inflation Reduction Act. I mean, and, there was an article too, just about how there was all this interest, like just like there's a green rush, of firms trying to figure things out, and the DOE is like trying to even get it staffed so that they can figure out how to disperse funds and how it's going to work. It's so early yet, and they don't have that capacity, just like the pandemic, where there was all this money for the pandemic, but that the dispersal was slow in some instances. And I mean, the signal is good, and there is, I can't remember how much money is being, put forth, but I know that, for example, hydrogen, these hydrogen hubs. I mean, what's your take on the hydrogen issue? I mean, I know it's not as dense, an energy source as, others. And I just wonder, if that's really going to be effective. Is it just another thing at the margin that we need to do anyway, just to reduce, carbon footprint?
I worked on some of the first companies that were working on fuel cells 30 years ago. And so I'm very skeptical. And I quickly figured out that that wasn't very likely to occur anytime soon, which unfortunately, I was way more right than I wished I was, since I'm a big environmentalist. But the more practical in terms of actual use of hydrogen, particularly with automobiles, is hybrids, and not pure electrics, but hybrid with smaller and smaller gasoline engine. So that's the most practical approach. But of course, that rarely wins out in the environmental arena, because it's dominated by extremism on both sides. Either extreme people just totally ignoring the fact that we're, emitting millions of tons of mercury every year into the environment, versus also, on the extreme, that's on the extreme right, on the extreme left, ignoring the fact that if you just produce more natural gas, you could shut down coal. So there's a lack of being practical, and hydrogen is pretty fundamentally not practical, because you have to cool it to ship it to negative 425 degrees Fahrenheit. So it's a more of a marketing tool. It can be shipped and used just as a transport if you're going to generate green hydrogen, and there's a steel plant being built that's going to use the hydrogen. But I think it's more ESG marketing than it is a real significant solution. But that's why, I don't like to argue about these things, because look, I'm like I said, I do not like my children breathing in coal dust. So if the hydrogen was the answer, I'd be all for it. But I'm very leery of solutions that don't solve the problem. So that's why you just absolutely, if you care, have to have a carbon tax, maybe cap and trade, but because then we don't have to argue about it. The carbon tax will clear the market. If hydrogen's the right answer to get rid of the carbon, then it'll dominate.
Right.
It's conservation, that'll dominate.
Right.
Whatever it could, it's probably going to be 50% conservation. That's just because you save energy and you reduce carbon. So we get paid for both. That's going to be the most economic.
Right.
But I don't to prove that it would require, hundreds of supercomputers.
Yeah.
So instead of arguing about it, we just really need to have a carbon tax or cap and trade, but better to have some revenue they can disperse as well and offset impacts.
Right.
So that's where all these arguments are kind of tragic, because we don't even know. Like, there's a pretty strong argument that electric cars have no significant pure electrics impact on carbon emissions, particularly when you consider the mining of batteries. But I don't want to argue about it. If you have the carbon tax, then that'll show up in the economics.
Right, absolutely. No, exactly. It levels the playing field, and it stops trying to pick winners, which, obviously the IRA does a lot of picking winners. I mean, it doesn't seem like the amounts are significant enough to, make a dent, but it is a signal, and I'm always concerned that we're gonna go the wrong way, and we're
No,
not.
the reason I don't worry about it is that it's unambiguous. Well, I don't think there'll be a tremendous incremental production of wind and solar, because wind and solar is the only thing that really makes a difference, because there's a limitation on siting.
Yes.
So maybe at the margin, it'll increase a little bit, but that's still unambiguously wonderful for humanity, because you don't have the emissions, particularly of coal, to the extent it displaces coal.
Right.
It's not just mercury, it's SOx, NOx,
Yeah.
coal ash, and coal dust.
Yeah.
And so and it's in the US. So even if it doesn't really address the carbon issue directly, it's unambiguously great for the US environment. So I don't worry about that waste at the margin as it being the ineffective at dealing with carbon, because anybody and this isn't even that controversial. The issue of carbon and cap and trade, something that's been embraced by the right and the left, not necessarily politicians, but by strategists and advocacy groups, definitely been advocated by the left as well as the right. It's not really controversial, just that politicians don't get paid to increase taxes. They don't get reelected to increase taxes.
All right. See, we talked about, one other thing I was gonna sort of talk to you about a little bit, because we've kind of covered the other things. We talked a little bit about the other day, we were just talking about sanctions, and there's all sorts of new, the Europeans are trying to put price caps on Russian oil, and as we have discussed, Russian oil is already being discounted anyway, and it's going various places, and like you say, oil is fungible, so it's just rerouting. So what could you say about what you observe about the sanctions, or anything?
I think it's just a desperate attempt, by politicians to try to reduce, put more pressure on Russia.
Yeah.
But it's just fundamentally very unlikely to work, because there's a tremendous incentive to cheat, which is already built in the market, because you can sell the crude at big profits. So it's just something that politicians like to talk about, but it's not likely to solve the problem.
Right.
Because oil can be shipped easily and is fungible. So the chances of you really being able to hurt the Russians in the short run is not that high.
Right. Yeah, because in the end, it's not going to stop the violence per se.
Right. I mean, it would be nice if the Russians had less revenue, but I don't think at the margin that's going to end the war.
Right. Yeah. Not quick enough. It's not Iran that's been, having its economy hobbled for a long time. And it's showing up, in social unrest increasingly. But so is there anything just top of mind that's, with anything, US production, flow of capital, decarbon, anything top of mind that you want to mention?
I think that the dynamic that's at play, at least at this moment in time, that most people don't appreciate, it's just a seasonal element of oil and gas prices. And so a lot of people might be saying, oh, well, Europe has enough storage of natural gas.
Right.
Well, we won't know if it's enough until we have the winter. It might be enough.
Right.
And you could say, oh, well, actually, oil's cratering because there's global recession and that problem's solved. But we won't know until we get to the winter. So that, to me, is kind of not in the current discussion, but is the key dynamic right now in the market for oil.
Yeah.
It's just pure seasonals that people are just kind of ignoring because they just sort of have a short memory.
Right. I'm just going to stop recording a second here.